Hello, I'd like to talk about Japan today. The market's up almost 30%, that's 30% year to date in sterling terms. And this has coincided with weakness in the Japanese yen. That's often the case when it comes to the Japanese stock market. It's generally thought of as an exporting market. And as a result of that, weakening of the currency tends to provide a fillip for the stock market. What I mean by that, I suppose, if you think about selling stuff into the rest of the world, and if you price it in yen and other people are buying it, having to translate their local currency to buy the yen, if the yen weakens, essentially what that means is the same product is cheapening in your local currency, which obviously makes it more attractive. It becomes more competitive compared to perhaps other equivalents you could use out there. So it's cheapening up. That makes it more attractive, and as a result of that, you're likely to sell more. Also, thinking about it from a sort of business profitability standpoint, if you're selling in a different currency, you might be based in Japan, you might be selling things priced in dollars, which is remaining strong versus the yen. If your cost base is predominantly in yen, you're incredibly profitable if you're getting sort of the same amount of dollars coming through, but your costs are sort of becoming lower when you think about it in terms of those dollars. So either way, you can see why weakening of the yen is beneficial for the stock market. But the yen has weakened a lot. To give you some context for that, it's getting close to the lowest level against the US dollar in 40 years. And generally, when you get that kind of scale of currency weakness, governments think about sort of intervening. One of the major causes of that weakness has been, I suppose, interest rate differentials. You've got a much lower yield, although substantially greater than zero, much lower yield than you would get in US dollars, for example, just for holding the currency. And that interest rate differential encourages people to sort of move away from the yen into high yielding currencies. On top of that, you've got things like the carry trades, which do that on a sort of often on a leverage basis, increasing sort of pressure, I suppose, on that. As it happens, the Liontrust multi-asset team has been constructive on the Japanese stock market since November 2023. We moved it from a neutral 3 in our scoring of between 1 and 5 to a 4 back in November 23. And obviously year to date in particular, that scale of performance has really sort of come through in terms of the performance of the funds and the portfolios. Particularly when you bear in mind, UK's up sort of 5-6%, US is into double digits, but Japan is performing much better than either of those two. To give you some context there. Why this is topical today is overnight the Japanese finance minister made a comment in a Q&A about whether they should sort of encourage greater investment domestically, trying to sort of reduce the amount of capital flowing out into the rest of the world. And obviously the US as an example of that. And that's really important because, the Japanese government pension is actually one of the biggest pensions in the world. It's something like 1.8 trillion US dollars. And so, even a marginal move of a fund of that kind of scale would actually potentially have a really significant impact. Another interesting feature of that is, the Japanese government is a major holder of US treasuries. I think it's the biggest holder of treasuries in the world. And so again, you can see a change in that sort of policy could very easily make some significant capital flows come another way. And that sort of made me think, more generally, if you think about the sort of momentum in markets that we've seen, quite profound momentum in recent months and years. And really, I suppose the majority of that momentum has been flowing out of markets outside of the US and encouraging a flow into the US, really sort of a symptom, I suppose, the fact that it's got massive businesses there doing very well. The economy is growing and the stock market is growing compared to other major markets out there. And some of that is because of the fundamental results of these businesses. And some of it is almost sort of self-fulfilling because you get a sort of a drawing of capital out of the sort of peripheral majors into the US. So it's sort of, there's both sort of a cause and an effect coming through in that sort of reasoning. And if you think about this idea of being a bit more sort of protective of capital, it's not an alien concept. It's something that actually we've been discussing in the UK for the last few years, talking about sort of whether ISAs, for example, should stay domestically. And in fact, many sort of governments around the world do have not sort of formal capital controls, but they do have sort of encouraging of sort of large buyers, whether it be sort of institutions like government pension funds or retail saving schemes, some sort of encouragement of investing domestically. And when you think about the general mood music globally, it is a sort of a move away from this sort of profound globalization to a more sort of insular approach, whether it be geopolitically, whether it be in terms of defense. We've seen lots of moves that way. Perhaps capital is likely to go that way too. Maybe you can argue America first is sort of a part of that trend as well. Tariffs, perhaps, the other side of that coin. And you think about what the long-term implications of that could be if there is greater sort of fettering of capital flows around the world. If there's a greater encouragement of domestic investing, it could sort of bring a new direction, a new sort of thematic approach to markets and unwind some of this really sort of material momentum we've seen into the US over the last few years. What would that mean? Well, I think ultimately, it could create some strange dynamics in the short term, but what it would likely mean in the long run is sort of a greater differentiation from what we've seen in terms of capital flows over recent years, a greater sort of move towards domestic markets rather than sort of this sort of global impulse and, American exceptionalism, and perhaps markets like the UK, perhaps Japan, perhaps Europe, majors that have been sort of somewhat unloved, could at least on the margin get flow domestically, which may well sort of benefit them. And what that really speaks to, ultimately, we believe, is again a reminder of how active management could play such a crucial role in this sort of emerging environment that we're moving into. We think we're in a period of profound change for lots of different reasons, geopolitically, socially, and in terms of the global economy. But against that as well, if capital flows start to sort of move away from the way we've seen them sort of establish themselves over the last sort of decade or two, it would really, argue a case, we believe, for active management to be in a position to sort of take advantage of this new direction rather than, I suppose, just kind of rolling forward the one-size-fits-all approach we've seen in recent years. So that's really why, at one level, you might think it's a bit of a sort of niche topic to be discussing today. I think it's very interesting because it is such a live topic, but crucially, what it could actually represent is a far, far bigger, more powerful force in markets, which might well have long-term implications for active management and a great opportunity for nimble, long-term, active and differentiated managers to invest from here. That's it from me. Have a good weekend when you get there, and we'll see you next time.